There's a strange thing that happens when government runs out of discipline. They slowly and surely start changing the definition of the words. Spending becomes investment. Deficit becomes financial anchors. Subsidies become affordability. And the political allocation of capital moves from cronyism to nation building. And somehow, a government projected to spend tens of billions of dollars more than it takes in tax revenue can stand in front of Canadians and claim that they are spending less to invest more. That line alone deserves to be bronzed and placed in the Museum of Fiscal Gymnastics, right beside the exhibit that says I maxed out my credit card to improve my balance sheet. Finance Minister François-Philippe Champagne used that sentence repeatedly in his spring economic update, saying that the government was committed to spend less to invest more. That same update projects a federal deficit of $66 billion this fiscal year, followed by continued and ongoing deficits across the forecasted horizon. So this video isn't just about one budget update. It's an attempt to translate the language of the administrative state and to understand the psychology of political management. It's about what happens when the people who actually produce wealth in an economy are told that those who tax, borrow, lend, and regulate are the only ones building the economy. And most importantly, it's about what the Canadian entrepreneur, family, and investor should understand from this spring economic update. Because the message underlying the euphemisms is clear. Ottawa is not willing to reduce the scope of government acting and intervening in the economy. They are only trying to reframe the language in a way that seems palatable to the majority of voters. So let's begin with the first euphemism, fiscal discipline. The government is saying their fiscal position is strong. It says that the deficit is lower than projected. It says that Canada is on track to meet its fiscal anchors. But let's look at what that really means. The deficit for this year is now projected to be $66 billion, and yes, that is lower than the originally planned budget deficit of $78 billion. But the same table shows continuing deficits year after year. $65 billion the next year, $63 billion the year after that, $57 billion the year after that, and so on. That is not a balanced budget or retaining some fiscal anchor. That is a massive leak. And when your boat is taking on water, claiming that the hole isn't as big as it was before, doesn't really matter when you're taking on water. But the improvement in this year's fiscal outlook is not because the government is implementing some structural reforms. The update stated that the improved oil prices have improved the state of trade. Nominal GDP is going to be $30 billion than originally predicted in Budget 2025. And budgetary revenues are expected to be $7.2 billion greater than originally anticipated, partly due to the fact that this notional GDP increase is now in play, and partly due to the oil prices now being significantly higher, resulting in higher royalties. Translation, the government's fiscal position has improved because of notional tax base increases. So some of that is due to higher real growth, and some of that is higher to commodity revenue. And yet some of that is part of the old fiscal magic trick. Inflation and nominal income growth pushing more dollars through the tax system. The state collects more revenue, not necessarily because it governed better, because the numbers are larger. That matters because inflation is not just a cost of living issue. Inflation is also a tax collection mechanism. When prices, profits, asset values, and transactions increase in nominal value, governments collect more revenue even though people do not feel richer. And that's fiscal drag with a smile, not real prosperity. The Austrian economists have always warned that inflation is not neutral and it doesn't hit everybody equally. It changes relative prices, distorts calculation, and rewards some actors before others. And it transfers purchasing power through the monetary system before people even realize what's happened. So when a government says our fiscal position has improved, the first question we need to ask is, for whom has it improved? For the household who is trying to buy groceries, or for the entrepreneur or investor looking to plan and develop their strategic vision, or for government whose revenues rise because the nominal economy inflated. That's like riding an inflation horse and calling yourself a cowboy. There's no fiscal discipline needed. And it's not like it's even a good cowboy. It's more like the person going to his first Calgary Stampede who buys his Stetson at the airport on his way in. Murray Rothbard, in his essay Economic Depressions, Their Causes and Their Cure, said that we live in a world of euphemisms. He was talking about how economic crises were being softened rhetorically. Panics became depressions. Depressions became recessions. Recessions became downturns, slowdowns, and sideways movements. And this is exactly the frame of the Spring Economic Fiscal Update. It is a language document. The government is trying to convince Canadians to see the expansion of state governance as prudence, debt as investment, and political allocation of capital as national strength. But words do not change economic reality. Calling spending an investment does not make it an investment. Calling debt a wealth fund does not make it wealth. Calling political favor as nation building does not make it productive. Calling subsidies affordability measures does not mean prices have improved because supply has expanded. Rothbard's point was just not linguistic pedantics, it was psychological. When reality becomes uncomfortable, the language shifts to become softer. And the softer the language becomes, the harder the citizens have to work to understand the truth behind it. And that's why euphemisms matter, because sometimes it's not a lie. Sometimes it's worse. Sometimes it's a sedative. It helps make reality less alarming, less morally urgent, and less politically costly. And that is the genius of the modern fiscal language. The government just doesn't simply come out and say that we're borrowing from tomorrow's taxpayer to fund today's political urgencies or ideologies. It says we are investing in Canada's future. It does not say that we are choosing the firms, projects, and regions that align with our political ideology or strategy. It says we are building Canada strong. It does not say we are creating another government agency to layer on top of all existing frameworks. It says we are building Canada's first national sovereign wealth fund. And that really brings us to the centerpiece of the Spring Economic Update. Canada's Strong Fund is being described as Canada's first sovereign wealth fund. The Prime Minister's press conference the day ahead of the Spring Economic Update outlined the plan of having and establishing a fund that will be seeded with $25 billion of government funding alongside private capital in order to invest in critically important infrastructure projects and resource development. The Canadian projects and companies will be focused on clean and conventional energy projects, critical minerals, infrastructure, and agriculture. The government also plans to run a retail investment product, whether that's alongside the Canada Strong Fund or part of it. And the idea is that Canadians will be able to invest in the fund and the things it's investing in. Now, this sounds all wonderful and strategic and prosperous. It sounds like Norway, and Mark Carney actually suggested this was going to be a lot like Norway's own wealth fund. But that's precisely the problem, because Norway's wealth fund is built very differently on a very different foundation. Norway's government pension fund Global was designed to collect the royalties and revenues from the oil and gas sector driven by offshore drilling in that country. Norway originally established this fund to shelter its economy from shocks in volatile oil prices and to serve as a long-term savings plan. Its first capital transfer came from the Ministry of Finance in 1996, again from oil and gas royalties. And it was transferred to the fund to provide the seed capital. The order matters. Norwegian companies produced oil and royalties were earned. A portion of those royalties were set aside and saved and invested in this fund. And although the details are very sketchy at this point, the Canadian model is looking very different. Canada is running major deficits. In fact, they are planning over the next 5 years to run hundreds of billions of dollars of extra debt. The government's own debt strategy projects $571 billion over the next several years. including refinancing and financial requirements. So when a government running those kinds of debt numbers is announcing a $25 billion pledge into a wealth fund, the first question we have to ask is, where's this wealth coming from? And if this is being debt financed, then this is certainly not a sovereign wealth fund in the classical sense. It's a sovereign leverage fund, or put more politely, debt dressed up in a tuxedo. Now, Austrian economics is very valuable here because it gets us past the visible objects. Now, Henry Hazlitt's great economic lesson was to look past the first object or the first effect of a policy and look at the longer term effects. And not merely at one group, but across a diverse group, all participating in an economy. The visible object is the Canada Strong Fund. The invisible object is the capital that could have remained in private hands in order to provide the seed capital. These are extra tax dollars that could have stayed in the hands of entrepreneurs who provide jobs. That borrowing capacity could have been used to reduce debt, or flowed into projects on its own if the regulatory and tax environment of Canada had been more favorable. When the government takes capital out of one part of the economy and moves it into another part of the economy, it is not creating wealth. It is merely reallocating the capital that already existed. And the political allocation of capital is not the same game as the market allocation of capital. Market allocation of capital, or investment, is driven by profits and the risk of loss. Government investment is mostly disciplined by politics, public relations, and the eventual hope that nobody remembers the original promise. When we're considering the validity of a sovereign wealth fund, I think we have to ask the following questions. Number one, what is the purpose of the fund? There is already a function to pay for infrastructure projects and already a means for the public to invest in different structures and projects if they wish. Number two, what problem is this solving? I think the government is attempting to not look at structural reform and only kind of paint over the pothole rather than actually digging up the road and repaving it. Number three, what additional information will be released to the public before it launches? The only thing that Finance Minister Champagne has said about the fund, there's no other details other than this, that is going to be launched in the next few months. No details, no pro formas, no ideas yet of how this is going to actually work. And despite his optimism about it being launched in the next few months, this is going to take years to develop and design the framework and to put the right people alongside this project. And number four, this is something that I haven't heard any of the media heads or anybody else comment on. The central issue is that the government is not just releasing some fund. It is entering into the capital market space, while at the same time, it's the rule maker. It's the regulatory's political superior in many aspects. It's the issuer and the sponsor of the product. It selects the politically preferred projects, and it's competing in the same space for private and institutional capital, both foreign and domestic. This makes this sovereign wealth fund not just a normal market participant, it also makes it a competitor. The Spring Economic Update says that the fund will invest in strategic Canadian projects and companies, mostly through equity-like instruments and alongside private capital, and with a mandate to earn market-based returns. It also says that ordinary Canadians will be able to participate in this fund and sharing in the upside while having their principal protected. And there's two questions that are raised by this. Who is protecting the capital? And here's something bigger. If a private issuer offered Canadian retail investors upside exposure to illiquid infrastructure, energy, mining, agriculture, telecommunications, or strategic company investments, while implying principal protection, what disclosure, suitability, liquidity, capital, conflict of interest, and registration obligations would apply? Private actors don't just get to say, don't worry, we're nation building. This legal precision matters. The Canadian Securities Framework is made up of 10 provincial and 3 territorial regulators. These regulators oversee the financial markets, including mutual fund managers, exempt market dealers, portfolio managers, restricted dealers, and investment fund managers. Generally speaking, securities offered to the public require prospectus unless it is exempt from doing so. The OSC's investor education materials state that exempt market securities can be sold without a prospectus. But it also warns that this could lead to less disclosure or even illiquidity and a risk of loss. It also means that a prospectus exemption does not mean that it has an exemption from registration requirements. So the core issue with the sovereign wealth fund is this. Is this retail product going to be treated like a normal retail investment product, a government debt product, an exempt market product, or a custom political instrument created by the state? This distinction matters enormously. Under the Canadian securities rules, there's already prospectus exemptions for certain government-backed or government-guaranteed debt securities. For example, National Instrument 45106 states and provides that the prospectus requirement does not apply to a distribution of debt securities issued or guaranteed by the Government of Canada or provincial government, though the Ontario carve-outs and local rules matter. But here's a possible issue, that the Canada Strong Fund is not your normal, everyday, boring old debt security. It is being thrown out there and marketed as participation in the upside to strategically important national investments. If it is effectively a government debt, then let's call it a debt. If it is an investment fund, then let's regulate it like an investment fund. If it is a hybrid product with public-style downside protection and private market upside potential, then the disclosure should be held to a higher standard, not a lower one. Let's put it another way. Ottawa is getting in the market of capital raising and competing in the institutional space. And its investing products already shaped by policy. And if a private money manager tried to go to the Canadian marketplace and tried to raise funds for a potentially illiquid, politically selected long-term capital infrastructure and strategic industry investment plan, that manager would face some serious securities disclosure, suitability standards and risk acknowledgements, registration requirements, audit reporting, liquidity disclosures, and intense scrutiny over possible conflicts of interest. So why should a government fund get a softer path? Because it is wrapped up in the language of patriotism. This exposes a real scandal here, which is regulation asymmetry. Private capital must comply, while government capital gets to rebrand as nation building. And speaking of downside protection, what happens if this fund loses money? Who's protecting the note? And if the answer is the government, then in reality it's the taxpayer on the hook for absorbing the downside loss. If the answer is the fund structure, then the fund needs to be explained. And if the answer is portfolio design, then it's not really guaranteed at all and should not be marketed as a protected note. And if the answer is future legislation, then Parliament is being asked to create a retail investment product that is somehow politically isolated from normal market discipline. And that is a major issue. The next euphemism is nation building. This phrase is everywhere in modern politics because it gives normal spending a heroic glow. You are not funding politically selected projects, you are nation building. You're creating resilience in the market instead of supporting government overreach. You are not reallocating capital based on the preference of politicians, but you're securing the future. And we have to bring in more economic thought. Some Austrian economists, such as F.A. Hayek in his book, The Road to Serfdom, who simply stated that tyranny just doesn't happen through a quick policy. That would be too simplistic. The deeper warning was that central economic planning required growing power within the bureaucracy and concentrated into a narrow view of a handful of people. And once political authorities claimed the right to organize the economic life of a nation towards some collective goals, economic power always translates into political power. Hayek's knowledge problem sharpens the point. In his essay, The Use of Knowledge in Society, Hayek argued that economic knowledge is dispersed among millions of people, and that prices coordinate that knowledge in no ways a central planner can replicate. And that's the problem with nation building as an economic philosophy. It assumes the state knows exactly what projects should be funded and who should be politically favored by receiving the government spending. It also determines what risks are acceptable and what outcomes will justify the cost. But the market already has a mechanism for that, and it's called capital allocation. Investors risk their own money and entrepreneurs test their own judgment. Consumers reveal their preferences through voluntary exchange, and prices determine scarcity. Losses punish error, and profits reward value creation. And the administrative state cannot improve this by standing over top like a helicopter parent with a clipboard, or worse, a magic wand. It replaces private judgment with political judgment, which is an inefficient way to determine capital allocation. If a private business owner makes an investment and it goes wrong, the bank is going to call and losses are going to pile up immediately. The business becomes squeezed out of the market because the consumer will flee to its competitors. But when a government makes a terrible investment decision, it can get buried under layers of crown corporation finances. It can get moved into a new fiscal framework or buried in another deficit. Or it could be defended forever as a long-term strategic capacity. In the private sector, failure is a signal, and in the public sector, failure is a funding request. And that's not just a small difference, it's the entire difference. We have seen this warning movie before. The Canada Strong Fund is being introduced into an ecosystem that already has things like the Canada Infrastructure Bank, Export Development Canada, Business Development Bank of Canada, Farm Credit of Canada, the Canada Indigenous Loan Guarantee Corporation, and many other programs. The Prime Minister's announcement ahead of the spring economic update in the House already lists these entities as part of the federal financing ecosystem. The Canada Infrastructure Bank was supposed to mobilize private investment for public infrastructure projects. And yet the House of Commons Standing Committee on Transport, Infrastructure and Communities issued a report with one recommendation: abolish the Canada Infrastructure Bank. That does not mean that every fund in the future will fail, but it should make people cautious. If the answer to underperformance by any of these entities is to simply layer on another entity, another fund, or another project, then the problem isn't capital. The problem is a philosophical belief that the economy is a motor and the government is the best engineer. But the economy is not a motor, it's not a machine. It is a natural order of spontaneous human action. The whole Austrian economic tradition, ranging back right from Karl Menger and running through Rothbard, Mises, and Hayek, knew this better than any technocrat could. Markets are not perfect, but it is a process of discovering signals as they come up. Government programs are not designed to see signals in the same way. Government programs are merely administrative processes. And the difference between the market and the government is discovering what people value rather than telling people what they should value. Another huge euphemism we need to point out is the difference between operational spending and capital spending. Now, in normal accounting, there is a real difference between capital expenses and operating expenses. Any business owner or accountant will understand this. There's a significant difference between buying a paperclip and a piece of equipment. Although given Ottawa's track record, I think buying the paperclip would require 3 consultants and a strategic bilingual document. Now, governments can use this difference between capital and operational spending as rhetoric to define what spending is virtuous and what spending is not. The spring economic update says that it's guided by 2 fiscal anchors: balancing operating expenses by fiscal 2028-2029 and maintaining a declining deficit to GDP ratio. It also says that direct program expense growth is driven disproportionately by investments identified in the capital building framework, with capital expenses growing faster than day-to-day operational expenses. But the bond market does not experience the government spending as some mere poetry. It experiences it as borrowing, repayment risk, debt servicing, and fiscal capacity. The government's debt strategy says that the funds are being borrowed for government's general revenue, though certain proceeds may be tracked for specific expenses. It projects gross domestic issuance of $566 billion in 2026-2027, including $433 billion of refinancing needs and $133 billion of financial requirements. And that is the part that the business ownership community should be concerned about. Accounting classification doesn't eliminate fiscal pressure. If the government borrows to fund capital spending, it's still borrowing. And as debt servicing costs rise, it crowds out future priorities. If today's spending doesn't protect tomorrow's tax increase, the label on the spreadsheet doesn't really matter to the taxpayer. A deficit is still a deficit, debt is still debt and interest is still interest. And eventually the payment arrives and the piper always has to get paid. And isn't it interesting that the piper always has to get paid right after an election? It's funny how the government is more efficient at issuing a tax invoice than a passport renewal. The public debt charges have a horrifying reality, and those debt charges are rising dramatically. That starts at $54 billion this fiscal year and rises to over $80 billion by fiscal 2030-31. Minister Champagne says this is due to the increase in the stock of debt and to higher interest rates. Servicing debt is the first claim on the public purse. You have to understand the hierarchy of the government spending before any dollar can be paid to healthcare, defense, infrastructure, or any social priorities. Bondholders get paid first. And with increasing debt stock and rising interest rates, that puts increased pressure on the entire balance sheet. And it means that future governments will have to make hard choices. Should they raise taxes, cut spending, or inflate away the value of the dollar by getting into more debt purchased by the Bank of Canada? And for taxpayers, this is another signal in the market that we don't need to know the volume, but we need to know the direction of the fiscal pressure of tax rates. When interest rate costs rise, debt grows, public spending grows, and this should be a signal to all taxpayers that the government will eventually have to reveal its insatiably ravenous self. It's starving, and the appetite for more tax revenue is unyielding. And that revenue will not come abstractly from the economy. It can only come from productive people, business owners, investors, and people sitting on large capital gains. Basically, anybody who's accumulated capital in a country where the government sees capital as a resource. And this is why fiscal policy is not separate from personal planning. It's the weather system in which your capital resides. Now let's move on to the euphemism of affordability. The government is touting the Canada Groceries and Essentials benefit, which has essentially replaced the GST credit. And the amount is being increased by 25% over the next 5 years, including a one-time top-up this June for eligible recipients. The update says that it will provide support for 12 million Canadians. This is not a direct subsidy to grocery companies. This is a transfer payment to households. And for people who are genuinely struggling, this cash matters. But the economic question is not whether households appreciate receiving the money. Of course they appreciate receiving the money. The question is whether or not this solves the cause of higher grocery prices. And usually demand-side benefits do not solve supply-side scarcity, especially if that scarcity is based on regulation. They reduce the pain of the symptom while leaving the cause of the disease intact. If groceries are expensive because of high energy and transportation costs, productivity problems, regulatory burden, supply constraints, currency weakness, labor costs, taxes, and monetary inflation, then sending money to people helps them pay the bill, but it doesn't make groceries cheaper to produce. In constrained markets, subsidies and transfers can be partially capitalized into prices, margin, rents, and wages. And that is the key idea. The person receiving the check is not usually the person who receives the final benefit. If supply is constrained and demand is supported by government benefits, then some of that benefit will leak away through higher and stickier prices. If left alone, the markets correct high prices themselves through supply, substitution, innovation, and discipline, and mostly through competition. Government, on the other hand, tries to solve the issue of high prices through transfer payments and benefit payments. One process attacks scarcity, and the other side subsidizes the higher price level. Once again, the state gets to present itself as a rescuer for a problem it helped create. And that is the psychology of the administrative government. First, intervene and create distortion in price signals. Then subsidize the people harmed by the distortions. Then subsidize the people that were harmed by the distortion. Next, claim that the subsidy provided is demonstrating compassion. And fifth, rinse and repeat. It's like setting your kitchen on fire and handing your family the oven mitts and calling yourself a housing affordability expert. And to be fair, not everything in the spring economic update is bad. There are some actually good news things in this. For example, reducing the CPP contribution rates. This is real relief, even though it is relatively modest. Streamlining the application process for the disability tax credit. This is positive news for people with long-lasting medical conditions and helps reduce the administrative friction for people that are already dealing with enough. Extending the first-time homebuyers repayment grace will help first-time homebuyers with some cash flow. Making the employee ownership trust a permanent fixture in the Income Tax Act has some real and significant benefits. The critique here, though, is that small patches of relief are being inserted to a very larger, expanding state administration. A little CPP benefit doesn't erase structural deficits. A disability tax credit improvement doesn't improve the flight of capital out of this country. A home buyer's plan doesn't solve the housing crisis. An employee ownership trust doesn't solve structural corporate tax reform. And a sovereign wealth fund doesn't substitute the issues that Canada is facing right now to be able to attract private capital without the need for government funding. And of course, there's many things missing from this spring economic update. Things like serious tax reform, things like serious regulatory reform. Where's the strategy to make Canada radically easier to build houses in? Where's the plan to reduce compliance for entrepreneurs? Where are the measures to simplify the tax code instead of trying to band-aid over layers of complex tax structure? Where's the signal that Ottawa understand that capital has choices? The fact that RBC published a report between 2015 and 2024, $1 trillion of investment capital left this country, this should be terrifying policymakers, because capital flight out of a country is not just technically on the balance sheet. It describes future business expansion, developments, and jobs. That capital flight is demonstrating that entrepreneurs and investors are finding Canada too slow, too burdened with regulation, and taxing too punitively to do business in this country. You cannot reverse that with mere slogans and pedantics. You have to make it a better place for people around the world to deploy their capital in Canada. That means tax competitiveness, easing regulatory and compliance burdens, respect for private property rights, and stable economic policy. And it's reversed by a government who understands you can't kill the goose that lays the golden egg. The spring economic update also include other political measures that are beyond the scope of this video, such as amendments that allow law enforcement agents to search and seize mail, as authorized under an act of Parliament. It also proposes changes to food security mandates, the Bank of Canada's cost recovery responsibility, and FinTrack. But as a matter of governing philosophy, the pattern is clear. More administration and capacity of the state to run our affairs. More information collection and economic management. More targeted authority. More trust us, we know where we're going. This is merely technocratic temperament. It does not usually announce itself as authoritarian. It announces itself as competent. It says the world is uncertain and complex. The risks are large and the private sector is insufficient. The government, therefore, must step in and coordinate and catalyze. And politicians must build, guide, invest, and direct. But the Austrian economic response is not being anti-progress. It's being anti-pretense. The Austrians figured out a long time ago that the economy is too complex to be centrally planned, and proper capital allocation requires real price signals. It says that political incentives corrupt economic calculation. It says that the private sector isn't perfect, but at least it's guided by reality. So what does this all mean for Canadian professionals and business owners? Number one, it means that we should all stop treating fiscal irresponsibility as background noise. It is now part of the planning environment. The spring economic update is not just a political announcement, it's a market signal. It signals that deficits are normalized and governments will continue using any means necessary to justify the expenses. It signals that affordability in the system is going to be continually handled not by structural reform, but by transfer payments. It signals that debt charges are going to consume more of the fiscal room, and that pressure on increased taxes is unlikely to disappear. And it signals that taxpayers should make the assumption that the state is insatiably hungry. So the practical response is not to panic, it's to plan. You need to think seriously about corporate surplus and retained earnings. We need to think about things like investment, tax, insurance, estate, and succession planning. Why? Because building wealth is not just about seeking a rate of return. It's about protecting our capital from the rapidly growing fiscal gravity of tax policy. There's also a moral framework here. Wealth is simply not created by announcements. Wealth is created when people are able to save and invest in production, and they produce goods and services that other people are willing to exchange voluntarily the things that they've worked hard for themselves. Government can and should protect the environment where people can exchange freely. It can enforce property rights, contracts. It can maintain the rule of law and basic order. But when the government sees itself as something more than just a protector of these environments, something shifts. The free citizen becomes less of an actor and more of an input. The business owner becomes less of a wealth creator and more of a funding source for social spending. The economy becomes less of a spontaneous order and more of a project. And that's the basic position of Hayek's The Road to Serfdom. It's not that just one budget creates tyranny all on its own, but rather the philosophy of economic management replaces over time the philosophy of freedom. And once that happens, the language changes first and reality changes later. So here's the bottom line. The spring economic update is full of language that sounds ambitious and patriotic. But underneath that language, there's a familiar problem. Debts rebranded as discipline and debt rebranded as wealth. Spending rebranded as investment, and subsidies spun as affordability. Political capital allocation disguised as nation building, and increased state control disguised as increased strength and control over the economy. And that is the real story. Not that motives are always bad or that politicians or bureaucrats are driven by evil or conspiracies. But Canada is not doomed. We are still a nation full of entrepreneurs, professionals, families, and investors. And we would all be able to contribute to a prosperous country if government simply stepped out of the way and let people act. But citizens also need to keep something very clear. Government is simply not going to shrink voluntarily. The interest costs on our debt are rising as a major budget line item, and debt is exacerbating the problem as it grows as well. Tax pressure is enormous, and inflation is still useful as a political tool. And capital will continue to move to jurisdictions who respect it. So we should all plan accordingly. We should not confuse nominal wealth with real wealth. We should not confuse government investment with market investment. We should not confuse a fiscal update with fiscal discipline. And above all, do not let your euphemisms do your thinking for you. Because the first act of financial self-defense is to refuse to let the state to reframe reality. Debt is debt, spending is spending no matter how you slice it, and risk is still risk. Remember that the state is not the fountainhead of wealth. Real wealth is created by those people who discipline themselves to save, invest, produce, take up responsibility, and serve the public. That is the economy that Ottawa is trying to manage, and that is the economy that Ottawa needs to leave alone. If you found this video to be helpful in your journey of discovery of financial literacy, economics, history, politics, and philosophy, make sure that you subscribe, like, and hit that notification bell for upcoming videos.